Billionaire investor Stanley Druckenmiller is sharply criticizing Treasury Secretary Scott Bessent's recent decision to double long-dated bond buybacks, characterizing the move as artificial suppression of yields and urging policymakers to, quote, let the bond market speak, end quote. On August 19th, the Treasury Department announced it would increase buybacks in the 10 to 30-year sector from $2 billion to at least $4 billion per operation. The announcement came shortly after the 30-year yield reached a 19-year high. Druckenmiller argues in the Wall Street Journal's op-ed that this is a dangerous intervention in a normally functioning market. Quote, this wasn't liquidity management, it was price management, end quote. Druckenmiller wrote that, noting that trading was orderly, volatility was contained, and the market lacked any genuine dysfunction that would justify such official action. Druckenmiller warns that artificially lowering rates hides the true cost of America's fiscal trajectory. He pointed out that the national debt has crossed $40 trillion, with a deficit running near 6% of GDP at full employment. Calling the long-term Treasury yield the, quote, only fiscal disciplinarian the U.S. has left, end quote. He went on to stress that every basis point of artificial yield suppression is a subsidy to procrastination. Suppressing rates, he argues, sugarcoats interest cost projections and allows politicians to delay necessary entitlement reforms. And I would say that goes on both sides for sure. Rather than managing yields, Druckenmiller insists the Treasury should return buybacks to small scheduled liquidity operations and focus on addressing the primary deficit. Quote, if the 30-year must trade at 5.5% to clear, that isn't a crisis, that's an invoice, end quote. He concluded by cautioning that governments attempting to defend prices against economic fundamentals inevitably lose that battle. At the last check, the 30-year Treasury bond yielded 5.23%, the 10-year bond was at 4.7%, and the 2-year was at 4.24%. The primary ETF, specifically tracking the long end of the Treasury yield curve, including the 30-year benchmark bond, is the iShares 20-plus year Treasury bond ETF, or TLT, which closed 0.62% higher at 82.56 on Monday. It was down 6.03 year to date, down 0.83 over the last month, and 5.16% over the last year. The S&P 500 index has advanced 11.58% year to date. Similarly, the NASDAQ Composite Index was up 11.81%, and the Dow Jones gained 10.41%. So do you agree with Druckenmiller? Are you worried? Should the market just kind of let price action happen? What do you think's going to happen? Is there doom and gloom out there about all of this? You'll have to let me know.